could you elaborate more on the investment style and strategy followed in this fund, particularly how you identify high conviction ideas and construct the portfolio?
Yeah. So one of the things which we keep in mind in this portfolio is that, as I mentioned, we already take a risk of concentration risk because we have less number of stocks. So on top of that, to reduce the volatility, we avoid taking any style risk. Style being either growth quality on one side and value on the other side. So what we have decided to do is that we run with this fund with a blend style. It's a blend of growth quality on one side and value. And how do we do that is that we try to, when we construct our portfolio, we typically try to identify ideas in three buckets of investment ideas. The core of the portfolio, which I would also say is the quality growth part of the portfolio, is which I called as sustainable businesses. These are typically companies which have a long sustainable runway for growth. Generally, companies who generate very healthy return ratios, healthy cash flows, and most of these companies will either will have very high pricing power, or they have are market leaders and they are gaining market share. They either have a cost advantage or they have certain network effects. So these are the basically the quality growth part of the portfolio uh, from a blend point of view. Now, to generate that additional alpha, we try to identify ideas in the cyclical opportunities part of the portfolio. And this again, this can be in any sector. Mostly, you will find this kind of opportunities in cyclical sectors like automobile, industrials, commodities, and some parts of obviously financial services, which are more cyclical in nature. And these are companies which we believe are going through a cyclical downturn. Their valuations currently are at significantly discount to their where it should be. And when the cycle reverses, both profitability and valuations improve, which can lead to good alpha generation. And the third part of the portfolio, again, I would say is the alpha driver of the portfolio, is something which I called either you can call transformation or turnaround opportunities. Again, this kind of companies can be found in any sector, but typically they are companies who have been traditionally doing very well, but currently going through a tough phase because of either some internal factors like change in CEO, change in management, or some external factor like regulatory issues, change in competitive intensity, or any other such factor. And if we believe that the stock has seen a significant correction, valuations are reasonable, and we see some signs of initial signs of turnaround in the business, again, because of the reversal of the earlier factors. And if we believe the company can generate good alpha, we try to identify such companies and make part of the portfolio. So basically, we identify ideas across these three buckets, and these three buckets put together makes a blend of both quality growth and value. Now what I'll do is I'll just give you one example each of these buckets to just maybe drive home the point better. So if you go to the next slide, so this is an example of sustainable business, and this is a part of our current portfolio. So all the examples I'm citing are part of the portfolio. And Bajaj Finance, I know, I think everyone knows. And if you look at the left hand side, in last 11, 12 years, their AUM has grown by 13x, and while generating very steady ROA and ROE. And what this has led to a significant, meaningful return over last 10, 15 years. The stock has delivered very strong returns and obviously delivered alpha for our portfolio. This is an example of cyclical company. Now, Tata Steel. So if you look at it, this is a typical commodity company in the steel business. Obviously, their margins are volatile, and which leads to obviously volatility in the stock price and the valuations. Now, if you look at it, what we have done on the left hand side, if you look at the profitability of Tata Steel's India business, and we plot the dotted line is the average profitability, and the blue line is the quarterly profitability. And when we added this stock in the portfolio, we saw that the current profitability is meaningfully below the average line. And on the right hand side, if you look at, these are the Chinese steel prices. Basically, uh, steel prices generally globally are determined by what is happening to the steel prices, and on top of that we have duties in India, but primary driver is Chinese steel prices. And if you look at that chart, you will realize that Chinese steel prices are also meaningfully below average. So what we realize in this company is that both the profitability is below average, the global steel prices are also below average, and there's a significant, I mean, obviously probability. We thought that both the steel prices could go up in China, which could lead to obviously prices going up in India, leading to a better profitability. So because of that, we invested in this stock, and obviously from our investment, the stock has done well. Even the valuations have gone up, and cyclically we have made a good return in this stock. And last example I like to give of a turnaround company. This is a portfolio company. I mean, this is, as Vetri mentioned, I was also a telecom analyst, so I've looked at this company for more than 10 years now. This is a company we have held across many portfolios, including the Focused Fund. And the I think story is also quite known. Is that if you look at 2016, before Jio entered the telecom industry, Bharti was earning an average revenue per user of almost 200 rupees per month. Post Jio's entry and the disruptive price competition, that ARPU, which was 200 rupees, fell all the way up to almost 120, 125 rupees. And what that led to was that the EBITDA margin of the company, which was 40%, fell close to 20, 25%. And in that time period, we saw multiple companies shutting down in the telecom industry. Before Jio came in, we had 6 to 7 players in the industry, and now we are barely left with three. And post that consolidation, since Jio was also not making money, you saw industry taking tariff hikes, and which led to the ARPU going up again from around bottom of 120, 125 rupees to almost 225 rupees today. And the EBITDA margins, which fell to 20, 25%, are now close to 50%. And the stock price, we very well know, I think the bottom, the stock price was below 300 rupees, and the today's stock price is above 800 rupees. So it's been a good journey, and it has helped our portfolio. This is a typical turnaround company. In this case, the turnaround was led more by change in the competitive intensity. First, the higher competitive intensity led to a downturn, and once we realized that the competitive intensity has led to the consolidation and now it could improve, we thought it's the right time to look at this opportunity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.